The former head honcho of the Department of Finance in Canada, a role currently held by Chrystia Freeland, has given a revealing interview where he talks about his economic worries for 2023 and his concerns over one very specific, very troubling issue with the way the country's current finances are being managed by the current government, a government that he himself used to be a part of. And this all comes on the very same day that the latest jobs numbers for Canada have come out, and it's shocked experts who didn't see this happening, and it's likely shocking the Bank of Canada at the very same time, which might prompt them to change their mind. So why don't we talk about what exactly this leader's warning is, both for you and for the government of Canada, and why experts and the Bank of Canada were shocked after the release of today's new report, and how that could have a big impact on every single Canadian. So let's dive right into the information, and make sure to subscribe to this channel if you haven't already done so, and with the first link in the description, you can sign up to get all of these sources that are used in these videos, along with some additional extra analysis at the end of the week. So first, we're talking about the former finance minister who actually left back in 2020, later 2020. That's this guy, Bill Morneau. Currently, his job that he did is filled by Chrystia Freeland. Morneau stepped down from his position as the leader of the Department of Finance for Canada about 6 months after the Liberal government started rolling out all of the billions of dollars in financial support at the beginning of the pandemic. This largely looked like the CERB, as well as even bigger than the CERB, more spending than the CERB, was the Canada Emergency Wage Subsidy. And apparently, Bill Morneau had some issues not with the idea that these supports existed, but with the way that they would be rolled back eventually, how they were going to be tapered off. And it's not every day you get information from a former Canadian government official who was an official for the very party that is still in power. And in this revealing interview that he just gave, we're going to get the full thing later this week, but we got some clips here, and one I'm about to show you. Well, it's rather interesting. We're going to get into more depth in just a second. Take a look at this.
For this government to be more effective, and everyone can always do better, more effective in managing the economy, it's about engaging with the provinces to make sure that we create those opportunities across the country. It's about engaging with the private sector and thinking about how working together creates a better business environment. I tried to do that while I was there. It was an ongoing challenge, and I think that is for sure a very important challenge for this government, especially today.
I take your point in all of that, but I'm going to repeat the question because it wasn't a specific answer. Do you think the Prime Minister is an effective manager of the economy?
Well, as I said, I think
And unfortunately, they stopped the teaser of this interview right there because it's supposed to be coming out on Sunday morning. But inside of the article that was attached to this teaser video, well, we got a lot more insight, and some of it's rather revealing, especially given Bill Morneau's views on what the current administration is doing wrong when it comes to the government's or the country's entire finances. When he was asked about whether or not his former boss, Justin Trudeau, is an effective manager of the economy and of the finances for the government, he said, "I think being an effective manager means focusing on a few things that are critically important and doing them every day. The challenge of the 24/7 news cycle response is that it takes your eye off the ball. And so for me, growth in the economy, long-term solutions, and healthcare crisis that continues to repeat itself, and thinking about that energy transition, they all need that perspective." So it may not seem like all that much at first, but when we read between the lines here, it actually says a lot about what he thinks of the current government. He paints the current government as if they're too concerned about what their image is in the 24/7 news cycle, what the issue of the day is, and how do they look when they stand up in the question period inside of the House of Commons, how do they sound to their constituents, instead of what he says is a more impactful approach of not worrying about the short-term day-to-day impacts of your statements in terms of how people look at you, but instead worrying about like these longer, broad-term or long-term 3 to 5 year issues like encouraging more growth in Canada, both in jobs, business investment, among a number of other categories. But he doesn't just warn the Trudeau government that they need to start focusing on more long-term issues instead of their short-term image. He also has some concerns and warnings for average, everyday Canadians, saying that this specific concern is one of his largest, saying that amid ongoing high inflation and with central banks only being able to raise interest rates to try to fight inflation, he's among the economic observers who's concerned about the country's current economic situation, going on to say, "I think the challenge that we're facing now is obviously significant, inflation is hugely problematic for people to deal with. And so when you raise interest rates, inevitably there's less investment. So I do worry about the recession that could come in 2023, which I kind of think we're already in the midst of. And you'll notice he mentions that the Bank of Canada's only solution to inflation is increasing interest rates, something they've done at a rapid pace over the past 8 months. And the jobs report that just came out today is going to have a big impact on the way that the Bank of Canada thinks about their future interest rate decisions. The idea is that by jacking up interest rates, you slow down the economy in a bunch of different ways. First of all, people feel less wealthy because their payments on their debt go up, meaning there's less money to spend in the economy on additional purchases because that's now going to your mortgage that's up $1,000 since last year. As a result, it's also supposed to slow down business growth, right? Because people are spending less money on those goods and services, which is why they expect to see in jobs reports that, well, jobs are going down and unemployment is going up because of these businesses not being able to make as much money, and as a result not being able to expand as much, not being able to hire as much. This is what they would expect to see if they're raising interest rates. That's what they'd expect, but it's not what they saw today. The labor force survey came out just today, and it is hot, 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 hot. Well, especially in comparison to what people thought it would be. You might not think that a 0.5% increase in terms of the country's employment is all that significant, but given what the Bank of Canada and economists were expecting, this feels like it's scalding hot. Instead of seeing what they expected, that employment would be down and unemployment would be up, they saw the exact opposite with this raise of 104,000 jobs in Canada and the decline in the unemployment rate going from 5.1% last reading to 5% this reading. This is the wrong direction in the Bank of Canada's eyes. And the wage growth that has been seen over the past number of months, of around 5% year over year, well, that has been sticky as well. We've seen December's wage growth compared to last December up 5.1%. That's 7 months in a row of over 5% wage growth. But of course, when you take into consider inflation, what the real wage growth is somewhere closer to minus 1.8% when you take into account inflation, because inflation is currently sitting at 6.8%. So 6.8 or 5% minus 6.8% gives us the real wage growth of actually down 8% and 8/10. Like I said before, in the Bank of Canada's eyes, this is not what they want to be seeing, especially when it comes to their fight, their war that they're having right now with inflation, right? Their main tool for fighting inflation is raising interest rates. That's pretty much the only thing that they can do to fight inflation, and these are the kinds of indicators that they're looking at as to whether or not this tool that they're using to bring down inflation is working or not. There are countless Canadians who are struggling with this increase in interest rates, and it seems like, based on this new information, the Bank of Canada might not be done yet. At their last interest rate decision, the Bank of Canada shifted the way that they talk about interest rate increases. Formerly, they had said, oh, next time we're going to be discussing how much to increase it. We're going to be at our next meeting discussing how much to increase it. This is what they were saying over the past number of meetings. However, the language at the last meeting shifted from how much to if they should or not increase interest rates, or if they should just pause and hold it at the current interest rate. But given all of this new information, it's very likely that they increase interest rates likely by 0.25% again, 0.25%. That's what I think is more likely now given all of this new information, though the Bank of Canada likely does know that it takes a while for their interest rate increases to actually cycle their way into all elements of the economy. We see it really, really quickly impact the things that are most impacted by interest rate costs, mostly housing, right? We've seen that correction happen very quickly, but we haven't seen the correction happen in employment, unemployment, and jobs numbers. Of course, many people are worried that if rates go up too much, people will just stop spending in the economy and we could enter a very severe recession. But the Bank of Canada is less afraid of a deep recession than they are of inflation remaining hot over the long term. They think that inflation over the long term would mean that they'd have to increase interest rates even more and really break the back of the economy. That's not what they want to do. So they're leaning on the side of keeping rates high in the range that they are right now and hoping that inflation comes down without having to do too much more in terms of interest rate increases. And it seems that this approach might actually be in line with what Canadians' biggest concerns are, especially looking at this new financial reports, financial priorities poll that CIBC puts out every single year. We got some new information about what Canadians are most worried about. In terms of financial concerns, Canadians are more worried about inflation than they are worried about rising interest rates and the potential of a recession. So in terms of most Canadians' perspective, breaking the back of inflation is what's most important, and that's the direction that the Bank of Canada is going right now, even if it means extremely high interest rates and the potential for a recession. Something I've been thinking about more and more these days is how we might be in a new era where we're sort of going back and forth between two negative situations. The first one being high interest rates while we try to tame inflation, getting it to the point where we enter a recession. The Bank of Canada needs to lower interest rates, stimulate the economy again, but then that could create inflation again that we have to deal with, where they would have to raise interest rates again. And this is the sort of cycle that I see us being in over the next number of years. Of course, nobody knows with a crystal ball what exactly is going to happen. Random things can happen and change the outlook at any point in time, but this is definitely what I sort of see happening as of today. During the 2008 financial crisis, the US government did a lot of financial stimulus, a lot of money printing through their quantitative easing program, and keeping interest rates low for a long period of time, which you would have expected to create inflation, but we didn't really see that to the same extent that we're seeing it now. And I think that the explanation for this is the decrease in globalization that we're seeing today. You see, if we have the disinflationary forces of globalization, supply chains being sort of spread out across the country to where there's cheaper labor, the cost of things goes down significantly, and that might have offset the potential inflation that we would have seen after the quantitative easing and money printing during the 2008 financial crisis. But now in this era of post-COVID where people are concerned about the strength of their supply chains and the impact that can have on their businesses, more people are bringing their production back inshore, back to their country, which means higher labor costs and higher end prices for consumers in the Canadian economy. So it will certainly be interesting to watch, and I'm curious what you think about all this. What do you think about Bill Morneau's warnings, both to the Canadian government and the way that they handle the country's finances, and for Canadians entering this potentially recessionary period? What do you think about the jobs numbers? Does that line up with your personal experience? Or are you experiencing something different? No matter what you think, no matter what side you're on, let me know down in the comments. I read every single one and try to get back to as many as I possibly can. And a quick reminder that if you haven't already done so, subscribe to the channel and check out that link in the description, the very first link, if you want more sources, all of the sources I use to make these videos, along with some additional analysis at the end of the week. But with all that said, thanks so much for watching, everybody. I really hope this video has helped you out at least a little bit, and I'll see you next time.